Good morning, everyone, and welcome to today's financial report. Let's start with a look at the U.S. stock market from last Friday. The three major indices barely moved, with the Nasdaq closing at 24,975, the S&P 500 at 7,411, and the Dow at 51,947. The surface was calm, but some negative weekend news has already been priced into the futures market. Tech growth stocks took a significant hit. The QQQ fell 1.34%, Tesla dropped 3.39%, and MSTR declined 2.54%. Money is quietly flowing out of high-valuation tech names. The Bitcoin Spot ETF and the Innovation ETF also fell, showing that investor appetite for high-risk assets is cooling off. Now let's turn to the global macro picture. The yield on the 10-year U.S. Treasury note is currently at 4.68%, firmly above the 4.6% level, and it has been trending higher over the past week. This suggests that the market believes inflation is sticky and that the Federal Reserve will keep interest rates elevated for longer. There is no sign of a liquidity easing. The VIX, or the Fear Index, is at 18.58, which is still within the normal range of 15 to 25, but it is near the upper end. It has risen more than 6% over the past week, indicating that market anxiety is building up. If the weekend's negative news continues to weigh on sentiment, the VIX could jump above 20 on Monday, which would likely trigger a sharp drop in stock index futures. The U.S. dollar index is at 101.47, up 0.54% over the past week. The dollar remains strong. A strong dollar puts pressure on emerging market asset valuations, and for China's A-share market, it increases the risk of continued outflows from northbound capital. Oil prices are also on the rise. WTI crude is now at $89.31 a barrel, up 7.23% over the past week, and is approaching the key $90 mark. Brent crude is at $96.78, just a step away from the psychological $100 level. Higher oil prices, combined with rising treasury yields, reinforce the view that inflation expectations will not fade quickly. Gold, meanwhile, is holding steady at $4,070 an ounce, barely moving. The fact that gold is not falling despite a strong dollar shows that the market's demand for hedging geopolitical risks remains strong. To sum up, the global market is in a risk-off mode. The main driver is the escalation of U.S. technology restrictions on China. Semiconductor talks have yielded no results, the entity list is expanding, and the U.S. House of Representatives has passed several bills targeting Chinese technology. At the same time, inflation expectations have not dissipated. So money is flowing into safe havens like gold and treasuries, as well as into energy as an inflation hedge. If we see an unexpected easing of tensions between the U.S. and China this week, or if Fed officials suddenly turn dovish, market sentiment could improve. Otherwise, risk aversion will remain the dominant theme. On the currency front, the yuan is trading around 6.77 against the dollar, both onshore and offshore, depreciating slightly by 0.26% over the past week. A stronger dollar and tense U.S.-China relations are putting pressure on the yuan. While there is no sign of one-way speculative depreciation yet, the direction is consistent, and this is not good for northbound capital flows into A-shares. Over the weekend, more negative news emerged. The U.S.-China semiconductor export control talks in Geneva ended without any compromise. Key U.S. senators have jointly written to the Commerce Department, demanding that 8 Chinese companies be added to the entity list. The House also passed bills banning DJI drones and prohibiting the federal government from using Chinese-made electric vehicle batteries. These are all negative developments. So for today's A-share market, we expect a lower opening. The weekend was packed with bad news. U.S. tech stocks ended the week on a weak note, and the yuan is slightly weaker. There is no positive catalyst. If the market opens strongly higher this morning, for example, if the Shanghai Composite Index opens up more than 0.5%, that would suggest that the market has already fully priced in the bad news and could stage a recovery. But the probability of a lower opening is higher. In terms of the index, we expect the A-share market to open lower and then continue to test lower levels. The support level for the Shanghai Composite is around 3,740 to 3,750 points. The Chi-Next board is under even more pressure. Last Friday, the indices already fell significantly. With more negative news today, it will be difficult for the market to stage an effective rebound during the day. In terms of sectors, utilities and power, as well as energy, are worth watching. In a risk-off environment, high dividend, low volatility utility stocks offer defensive value. With oil prices at high levels, the energy sector benefits from the inflation hedge theme and has low valuations, making it a preferred destination for existing funds. Sectors to be cautious about include domestic substitution and AI computing, as the weekend news directly targets semiconductors and AI. The expectation of an expanding entity list will weigh on these stocks. The new energy vehicle supply chain is also under pressure due to the battery bill. Small and mid-cap growth stocks should be avoided. Judging from the performance of the ARKK and QQQ, high-beta names are leading the decline. Northbound capital is more likely to see net outflows today. A strong dollar, a weak yuan, and deteriorating U.S.-China relations create a triple headwind. Foreign investors have no incentive to increase their holdings of A-share growth stocks. If northbound capital inflow exceeds 20 billion yuan in the first 30 minutes of trading, that would be a positive surprise and could help stabilize the market. Otherwise, we expect net outflows of more than 30 billion yuan for the day. To conclude, there is no easing of U.S.-China tensions, the VIX is rising, and global risk aversion continues into the new week. The A-share market will open lower and test support. The strategy is to stay defensive. Our probability assessment for today is 20% for an up day, 30% for a sideways day, and 50% for a down day. In terms of trading, we recommend a cautious approach and waiting for clearer signals from the market.